In this room, there are 70 lawyers and 10 engineers. The other 57 people are hiding. I pick out one of them, and he says that he dislikes politics and he likes to work with his hands. Where are his eyes? Okay, and pretend that there is $10 on the line if you get this right. Do you think he is a lawyer or an engineer? Most people would guess he is an engineer, even though it is statistically unlikely that he is. The base rate fallacy is the tendency to neglect important base rate information. We take this new information that he dislikes politics and likes to work with his hands, and we use that to guess that he is an engineer. However, we fail to recognize that any person randomly selected in that room is 7 times more likely to be a lawyer. We ignore that base rate information. In trading, base rate information can be referred to as the day's trend. We might see a double top candle pattern, take that as a bearish sign, and enter a short position since the price had failed to break the high. However, we ignored the fact that the market had been going up the entire day with only minimal pullbacks. The market heads down for a sec, but then immediately goes back up to break the high of day, and we get stopped out. We got trapped by the base rate fallacy because we failed to recognize the other information that could have been used to make a better informed decision. In supply and demand trading, be careful about taking a position that is counter to the overall trend, which is the base rate information. Even if it looks good for a reversal, if the market has failed to reverse 7 times that day, you need to focus on the statistical likelihood that a move will go, or not go, your way. As you can see right here, it made a lower low, but then went right back up to break the high of day again, and that pattern repeated itself before some big bullish momentum. You have to keep these failures to reverse in mind as part of the overall market context when taking positions. Also, the nightmare forehead alpaca chart pattern was a clear bullish indication. That is your reminder to stop looking at price pattern shapes as the holy grail of trading. If you don't, forehead alpaca will visit you in your sleep after you get margin called for blowing up your account from a failed reverse triple shark tooth formation. We should have answered the lawyer and engineer question based on the information that there were 70 lawyers and only 10 engineers. Instead, most people ignore that part and only focus on the new information. Let's do a little recap. The base rate fallacy is about how new information is used to make a decision without remembering the significance of the base rate information. In other words, something new makes us change our evaluation without paying attention to anything else. It's like using the tip of an iceberg to guess how fast the whole thing will melt. Fundamentally, that just doesn't make sense. You need to know how big the rest of the iceberg is, unless there is some sort of iceberg equation I don't know about. In investing, you see this every time some news event comes out that causes an emotional reaction in investors that causes some sort of spike in the price. For example, some official says that Delta Airlines has to close for one day because the new COVID strain Delta is in the air. Lines. Breaking news. Delta Airlines closes for a day because Delta is in the air, and lines. Investors freak out and panic sell, causing a drop in price. They ignored the fundamentals of the company and the entire reason that they were invested in the company because of new information. They based their decision off of this news while ignoring the base rate information. For investors, an event like that is but a blip in the cosmos, just like we are. Let's wrap this all up and make sure that we apply this cognitive error, which is the fancy PhD way of saying brain fart, to trading. After all, we are here because we want to be better traders. You've probably heard of plan your trade and trade your plan. This exists because it's easy to get antsy and impulsively take a trade. When we are supply and demand trading, we make our zones where we think there will be turning points in price action, and then you need to duct tape your hands to your own butt. No, not duct tape, duct tape. Just make sure that you get the tape off for when the price moves into your zones. Do not overanalyze the price action and make some dumb mistake because you think you see the dinosaur chart pattern forming. You need to be able to go into the trading day with your base rate information. Acknowledge new information as the price action develops, but don't let this action make you stray from your original plan. Ask me any questions you have and I will be glad to answer them as soon as I see them. I'm a senior in college, I enjoy and thrive in psychology, and I will be making more of these soon.